In just the past month, Oscr stock, or OSCR, has been going parabolic, jumping higher. This is actually one of 3 companies that I've personally been buying, calling out to my subscribers at Unrivaled Investing, saying, yeah, I think it does have over 100% upside potential, and it fits my investment checklist. And so I made an exclusive video that sort of walked through that. However, this actually isn't my first rodeo with Oscr. If you look back, I actually did a video. Hey, look at that, matching shirts. Did a video on Oscr a few years ago, calling it out, walking through the business model. And you can see since that video, my main takeaway was that, yeah, it has a lot of potential, but it's always important to separate potential from fundamentals. And because of that, in that video, I warned investors saying, you know what, I just don't think it's that compelling. I think there are other potential multi-baggers that are more compelling that investors should consider. That was from a few years ago. Since I made that video, Oscr has dramatically underperformed. At one point, it was down 90% from the time that I made that video warning investors. Even now, after the recent parabolic rise, it's still 20% underwater from that time of that video. So overall, I think that prior video was a good call. The question is, where does it go from here? And in this video, I'm going to provide sort of an overview, very high level, of why I'm personally am a share owner, a shareholder in Oscr. And full disclosure, I own a stake in Oscr, and sort of the framework for how I think it could generate possibly substantial returns in the future, and sort of the framework in which you could say, maybe this is a $100 stock, maybe this is even a $200 stock in the future. Now, I don't want to get into the hype train because this channel is a no hype, mission focused channel to try to find those potential multi-baggers, the types of stocks with hundreds or even thousands of percent upside. But I wanted to share my logic that goes into that, because I don't want to pound the table and say, yeah, this is going straight to 200. I don't think that's the case. Let's go through it. Let's sort of share the thoughts. Let's, consider the risks, and, important to understand stocks will be very volatile. But I think where it was when I first made that video versus where it is today, I think a lot has changed. And one of the big changes is the new CEO, Mark Brutolini. He's a seasoned executive. And truthfully, I really like, the data points that I'm seeing here. I see insiders buying more stock. I see the founders saying, hey, I still believe in the mission, but I'm better suited to running the technology aspect. And Mark Brutolini, hundreds of millions of dollars net worth, saying, I'm only in it if you're in it to change the healthcare problem in the United States. He doesn't need to do this. And that smells like alignment. That smells like a lot of potential. I love finding the rinse and repeat situations where you have a CEO that's like, yeah, I know how to create plenty of shareholder wealth. I've done it before. I previously made boatloads at Aetna, and let's do the rinse and repeat at Oscr. So when I see that type of dynamic where you see someone that doesn't need the money saying, yeah, I think we can crush it and here's why, that gets me interested. And that's Mark Brutolini. Doesn't need to be in the game, but clearly likes to create value, not only for shareholders, but for the system itself. And you've seen the fundamentals turn significantly more favorably. Yes, they continue to post hyper revenue growth, but they are starting to post real profitability. And you can see their membership growth, the number of members in this insurance company. Now it's still continuing this sort of exponential growth from around 1 million to closer to 2 million now. So you get this hyper growth, you have increasing profitability. These are the data points I like to see. And plus, in 2024, management called out, yeah, by 2027, we think we're going to be at 225 plus in EPS, or earnings per share. And personally, I think if they deliver on that, this milestone alone has the potential to drive the stock towards, let's say, $40 plus over time. And the reason being is that, yeah, if you have a hypergrowth stock that's winning market share, management delivering on the goals that they set out, and it's clear that this is a company with continued long-term growth potential, then just very rough math, $2 in earnings, ballpark, that's, it's a little more than that. They're saying 225, $2 in earnings, hypergrowth, maybe you're saying it's 20 times. Well, $2, 20 times, that's how you get to that $40 in earnings potential over the next few years. That's sort of the framework to think about. But once again, it depends on management executing, not only on delivering growth talking about 20% type of revenue CAGR, but also getting the profit margins as well. They've shown incredible progress towards this. Now, the key aspect that really jumps out at me, and I think I've personally seen this story over and over again. I've never been a Tesla shareholder, but I think it's an important data point that when you find situations where Wall Street's ambivalent or even doesn't like the stock and customers love it, at the end of the day, Wall Street will catch up to the customer as long as they have a sustainable, profitable business model. And that's what is so intriguing to me, is that Oscar's NPS or Net Promoter Score from their customers, and they have a wide range of different, if they say, look at their Hispanic customers or broad base, their NPS scores just blow it out of the park relative to the industry. And this is an industry, health insurance, where people are having their claims denied, huge negative, sentiment, versus Oscar. Huge negative sentiment where people are saying, I don't like this insurance. I don't like the setup. I want to get healthy. They're not treating me right. Versus Oscar, which is leveraging technology so folks can get better care, having that maybe a telehealth or having AI help sort of triage, okay, who you should speak with and making it possible, or just making basic medication more affordable for folks. And so I think this is a key data point. This is a North Star. If you see their NPS score drop precipitously in the years ahead, that's a red flag if it were to happen. That's not happening. So I think that's a key data point for investors to think about. The other key aspect, and this is why I like the situation, is that there's multiple drivers here. Not only are they winning in their existing markets, but there's several ways for them to grow and deliver this 20% revenue growth. There's this expansion in existing markets, i.e., leveraging the Affordable Care Act and opening in new states, taking market share in their existing states, launching or expanding with new products and markets. That would be ICRA, which we'll talk about in a second. The other is tied to the investment income. So there's a lot of revenue growth potential. There's also this thing called subsidy expiration. This is tied to the ACA market. Once again, the Affordable Care Act or Obamacare. We'll talk about that in a second, because this is the key part that could hurt the stock big time in 2026, and I think could create a lot of volatility for the stock. And so what is that subsidy expiration? This is the big uncertainty, is that you've had enhanced subsidies for customers on the ACA marketplace. And with these enhanced subsidies, they're expected to roll off at the end of this year. And based on your income level, that could result in a huge increase in terms of the amount of monthly insurance prices that you're going to pay. And in theory, it could not only result in higher costs for these consumers, but just a lot of people saying, I can't afford it. I previously was, maybe you were only paying $100. Now it's $250. And you're like, you know what? I just can't budget $250 a month. And you're just going to see more people that are underinsured or uninsured, and that's going to hurt the system. This is the big uncertainty, because this is currently, the vast majority, 90% plus of their revenue is tied to the ACA market, and these enhanced subsidies play a key role in that income and the consumers on that marketplace. It's a big uncertainty because President Trump's current bill is suggesting that it will expire, but this is the tug of war. Now, they're still saying, yeah, we still expect to grow. We still believe our total market opportunity in terms of our footprint is growing from 10 million to 16 million at a minimum. But if we lose these enhanced subsidies, that's about 4 million, that's give or take. If we had it, man, that would be great. We would be closer to 20 plus million in terms of the opportunity. But if we don't get those enhanced subsidies, then it's only a 16 million opportunity. Still, big market. Still, they're only around 2 million in terms of members. So still a lot of opportunity, a lot of growth potential for them. But it is important to recognize this could be a huge headwind in 2026. So the question is, where to from here for Oscar, especially recognizing the uncertainty around the regulatory framework? First of all, as always, none of this is financial advice. I'm just sharing my personal investment journey. And in full disclosure, I do own stock in Oscar, OSCR. is the ticker. Also, quick plug, just yesterday, Yin K, a premium unrivaled subscriber, wrote, "Grateful that you've created this service for the community. Extremely helpful and valuable." This follows Kieran D, who said, "Gave this service a try and was very impressed. Been investing 5 years now and haven't found anything comparable to what you're providing. If you're looking for compelling ideas, come check out Unrivaled Investing. I'm looking for potential multi-baggers, types of stocks with hundreds or even thousands of % upside over time." So when I think about Oscr, once again, I did a detailed video for my subscribers at Unrivaled Investing going through this checklist. The big one that I'm concerned about is, and the one that's sort of iffy in terms of the checklist, is the blow-up risk aspect. Usually I'm sort of thinking it's not necessarily no, but I want to say limited blow-up risks. What gives me comfort is the NPS score, but there are real blow-up risks. And this is the report, or there are real concerns around the challenges they could face. And this is from the report, completely free on Oscr from Flash, which, any company in the world, if you're interested in looking at, come check it out. There's a link below, completely free to get these company, reports and analysis. And I think it nails it in terms of what are the top risks that investors need to think about for Oscr, which is that it's regulatory, it's policy, it's the concern of this expiration of the enhanced ACA, Affordable Care Act subsidies after 2025. That could create sort of this cliff in terms of their revenue and profitability next year. You could see that reverse next year. Management still believes they can get to that, $2 plus in earnings, but this could create a real headwind for them. And there's also the risks that, as they grow, they onboard, let's say, more unhealthy members, like what you've seen with United, and that results in, worse margins for them because you onboard, less healthy members or unhealthy members, and they ultimately have to leverage the system more, resulting in higher costs. So you have these dynamics. These are, I think, this ACA subsidy is the top concern that investors need to think about. But I think what gives me comfort is zooming out, saying, 2026, it's tough to say. A lot of the, voters in red states use the ACA subsidies. So a lot of these, there's going to be a dance with a lot of these, Republican senators saying, I want to get voted in again. If we cut this subsidy, there might be pushback, from these voters. Maybe we could have some sort of patch. And I think that dance of maybe there isn't a hard cutoff in 2025 and maybe there's some sort of phased out enhanced subsidy. That's sort of part of the reason why Oscar's been rallying, is that it's not going to be a cliff. Maybe it's a phase out. And while it's getting phased out, there's this other growth driver that's picking up. And this growth driver, this is what really personally gets me excited. And I think this is what Mark Brutolini, the CEO, gets excited about, is this individual coverage health reimbursement arrangement, or ICHRA. This is actually something that I think both Republicans and Democrats in the United States can get around. Certainly President Trump is encouraging this, which effectively gives more control for the employer to say, look, we're going to, instead of sign up for a traditional plan where you have uncontrolled premium increases, we're going to have a defined contribution. We're going to say this is the amount that you're getting, and then employees can see it. And that's, that is an expense for them. So that helps them on a tax perspective. But they can easily budget out, this is exactly the defined contributions you're getting this year. So there's no out of control, inflation that they have to worry about. And it ultimately goes to the employee to say, you're getting this money. You then shop for the right plan that's for you. And the reason why this is so powerful is instead of the same plan for everyone, which won't offer, let's say, a niche benefit that an individual might be focused on. Maybe they're interested in, diabetic care, or maybe they're interested in in having kids in the future, or maybe there's obesity problems. You can look at the different plans that'll address your needs and say, oh, this is the pricing, these are the doctors that I want, and they can look at it and say, this is what I want. This is the solution, which is having employees select different plans themselves versus the company saying, this is your health care. It also creates marketplace capitalist dynamics where the insurers are competing by saying this is going to be the the most favorable offering I can get. And as a result, this is one of Mark Bertolini's main points. The inflation rate that you've seen with the ICRA marketplace, when you have people competing, for this, it's generally much lower inflation than where you have elsewhere. And so this creates sort of the nirvana of lowering the tapeworm in the US healthcare system, where it's just growing and growing and growing, getting it to decelerate significantly, and giving employees greater choice in terms of what exactly they want for their healthcare, while having greater understanding. What exactly is my employer paying for? Like, how much money are they actually giving me? So it makes it, very clear, and it's easy to set up. So this is sort of the big lottery ticket that Oscr is looking at. And there's early signs that this is growing very quickly, showing the exponential growth that investors want to see. They just tweeted about how for large employers, they were seeing a 34% jump in ICRA adoption. For small businesses, they're seeing over 50%. And so there's a lot of employers now starting to offer ICRA and looking at it and saying, yeah, this might be the solution, not only to employers managing their expenses, but employees getting better coverage. And so this is a very interesting dynamic. And I'd argue this is one of the key drivers. You need to have disciplined management that can say, yeah, we're going to keep our costs under control. That is fundamental. But this is a key driver to maybe making this stock, $100 or $200, let's say in the next decade. That's sort of the potential that you're playing for. And the reason why I'm saying that, and I'm not just saying this is just, pipe dream type of stuff, is it's currently the traditional ACA marketplace that they're looking at is around 20 million. That's total. They're not operating in all those markets, but that's what they're saying is the total. They're saying if you look at small employers and, whether or not they're under 50 people or under 1,000 people, you're talking about a huge addition in terms of how many people can be in this marketplace. You're talking about closer to 100 million people that they could be tapping into if more and more employers leverage ICRA. And so if this happens and you see Republicans and Democrats get around it, and Oscr continues with their growth trajectory, leveraging this ICRA opportunity. It's currently very small, but if more employers start leveraging and you're starting to see that exponential growth, then it's possible. I'm not saying it's for sure. I'm saying it's possible that you could see Oscr in the next decade have the potential to generate earnings, let's say closer to $5 to $10 per share. Based on that, hey, we're now rapidly expanding the opportunity from 20 million to 100 million. You lay out that as a Oscar's in this right position. They've already been taking market share in ACA. Why not continue that with the ICRA opportunity? You roll out 20% type of growth over time for this next decade, which they've delivered on. As long as they keep their costs under control, then you go from that, let's say $2 in earnings that they're targeting for 2027. Management has a history of outperforming relative to what they say, which is also something I like. And if you get to closer to $5 or $10, you can start thinking about, oh, okay, well, if you're at $10, you could be at, what if investors say this is an incredible potential and or you have the history of execution. Why wouldn't investors say 10 times earnings? Well, 10 times $10, $100. Is it possible that you could have investors say 20 times, still below the market multiple, saying this is disrupting healthcare, this is lowering costs by giving individuals more choice? It's possible. So that's how I'm thinking about it over the next decade. Do I think it'll be crazy volatile? Absolutely. Like, it has gone parabolic in just, short order, partly because of this ICRA news. It could easily lose a lot in just the next few days if, like the ACA subsidies, it turns into more of a cliff versus a phased out development. That could definitely happen. So this is not, let's say, my top position. It's not. It's something where I'm looking at it and I'm thinking, I would like to double it. I'd even be willing to double it around the current prices if I saw greater transparency that, doubling it from my own portfolio perspective if there was more transparency around that ACA potential cliff in 2026, because it's very clear to me you have the right management trying to create the right opportunity set for the healthcare industry and for Uncle Sam, trying to say, let's manage these costs so it's not as bad by effectively giving it to the employers and the individuals their choice for what is the right plan and rewarding what are the right insurers that are delivering the care that customers want and also the coverage that customers want. So I hope this video sort of walking through the opportunity for Oscr over this next decade. I hope it's been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. And by the way, as I already mentioned, this is not the only stock that I recently called out to my subscribers where I thought it had over 100% upside that I was recently buying. So if you're interested, once again, that's unrivaledinvesting.com. Thank you so much for watching.